Okay, good evening, everyone. Again, my name is Jason Maida. I'm with American Pacific Mortgage here in Sacramento. Really excited to bring to you our very first Sac State Alumni Homebuyer Workshop. We've been teaching these classes for the last 7 years, and we've always kind of thought about, wow, it'd be great to be able to connect with one of our local alumni groups to be able to teach this class that we've been doing for so many years. And tonight marks the first opportunity to be able to teach this. I think with some pretty good content, giving kind of what's going on in the total housing market and economic news. So hopefully it's going to be something that's going to be allow you to have more resources and tools to support you on your journey towards home ownership. Again, my name is Jason. I'll be facilitating tonight's class. If you didn't hear earlier, please use the chat function to ask any questions that you have. We'll try to weave those questions in through tonight's session. So if you have a topic that you want me to kind of expand a little bit on, or maybe you have a question, just go ahead and ask that through the chat. Now, because of the volume of attendees for tonight's class, Ken Fleck's going to be helping manage some of those questions. So you may get a response back from him via the chat. And then, if it's a question that we think could be really helpful for most of our guests on tonight's session, we'll go ahead and add those. But I'll try to do my best to keep up with your questions as we go through tonight. Again, as I mentioned earlier, we're based out of Sacramento. So actually, we're broadcasting tonight from our downtown office on J and 9th. So not too far from Sac State here. I've been in the lending industry for over 20 years, and I get a chance to help with primarily first-time home buyers. And so what we do is we teach classes like this across the West Coast. We have other partnerships with different universities, and we partner with Cal Hfa, which is the California Housing Finance Agency. They happen to be right over here on Capitol Mall, and they work with low to moderate income households. And so you're going to learn a little bit about their product line too as well. And that's one of the big things that we help first-time home buyers with in kind of designing home buying plans. And so we work with other products as well, standard conventional loans, FHA, VA loans. You'll learn a little bit about some of the USDA rural products. And like I said, we'll talk a little bit about CalHFA this evening. Okay. Now this class is designed to help put you on the path towards home ownership. So whether you're going to buy next month, end of this year, maybe it's a 2024 goal, we want to make sure that these resources or this class provides a resource for you. So you have, 1, 2, maybe 3 things that can help you on that journey towards homeownership. So here's our talking points for tonight. We're going to spend some time looking at the housing market. I'm sure that's on the minds of a lot of our attendees tonight. We'll spend some time looking at interest rates. In fact, today was a big day as the Federal Reserve announced a 0.75% increase to the federal funds rate. So I want to share with you tonight what that means to you as a consumer, as we're trying to battle through the inflationary pressures that we're all feeling probably in today's market. We're going to look at, does buying make sense? So we're going to take some time looking at a rent versus buy analysis and show you what kind of some budgeting could be for us on our journey towards home ownership. We'll spend some time also looking at credit. And part of credit, we'll kind of weave in student loans and how student loans can impact your qualifying. We'll look at loan programs, some of the income and assets that we'll need to document as part of the home buying process. And then the latter part of tonight's session will be around first-time homebuyer assistance programs and kind of what the process looks like for purchasing your home. So hopefully you'll find that stuff helpful for you. Again, we'll do questions too also at the end of tonight's class. So this session should run about 60 minutes and we should be able to get everything included in that period of time. Okay, so let's go ahead and launch into the slides for tonight. And by the way, all of the material that I share with you this evening, we're going to send to you via email. So we encourage you to take great notes for tonight's information, but we'll get you all the slides tomorrow morning. Okay, so let's talk a little bit about home buying. And when you think about home buying, it's probably going to be the biggest purchase you guys make in your financial futures. This isn't like running down to, the auto mall and buying that car that you've been eyeing. It's probably going to be, like I said, that biggest purchase you make in your financial futures. And this is the opportunity to be able to create stability, affordability in home ownership. This is an asset, and generally it's an asset that should appreciate in value over time and create equity. And equity is based upon how much the market value is of your home versus what you currently owe on a house. And that difference creates home equity. Okay. Now, there also is potentially some tax benefits that come with home ownership, the potential tax deductibility of interest. And that's something we'd always want to talk to a tax advisor about, but that also adds another layer of benefit. And I think one of the biggest things with home ownership is being able to control what your housing budget looks like, not having to worry about the increase of rents. And, I was looking at an article earlier today, and rents are continuing on the rise. And I know a lot of us in the Sacramento area are feeling that effect. And so when we're looking at and preparing to buy, I think a really great place to start as kind of a baseline is really doing a calculation to see what an analysis would be, and we call it our rent versus buying. And so I want to take you through this calculator. By the way, this calculation that we're going to share with you, we're going to send out, it's all linked in as part of our slideshow, but I want to walk you through kind of a real-time calculation as part of tonight's session. So what I have on the screen right here is the buy versus rent calculator. It's on the Freddie Mac website. And let's go through like a quick example, and we're going to do kind of an analysis of what it looks like to continue to pay rent. And what we're going to do this analysis, we're going to do it over a 7-year span of time. So we're going to look at what is it going to be if I continue to rent versus what it's going to look like if I decide to purchase a home one day. Okay, so let's first of all build our rental scenario. And let's say we're renting for, I'm going to go ahead and just plug in like $22.50 a month in rent. Okay, now I know that's going to be dependent on the size of the place you have. If you're renting in Midtown versus you're renting out by Sac State, that all those different areas will change based upon how much I pay in rent. Obviously, if you're renting a room, that's going to be a lot less. The goal of this exercise is just to understand, kind of the opportunities that come with buying, because it's not an apples to apples comparison. We look at renting versus buying. Now, of course, as renters, we have renter's insurance. So I'm going to plug in $15 a month per month in rent. Rental increase, let's just assume our rent's going to go up 3%. Okay. Home purchase, I'm going to go ahead and put in $450 for now. I think I'm going to leave that field there. Most of our first-time buyers that we talk to right now and consult with in home ownership are looking to purchase somewhere around $400,000 to $500,000. Just like renting, real estate's also going to be about location. So if we're going to look at Elk Grove versus maybe looking at Natomas, those prices could look a little bit different. Okay. And then in this or in the home price, we're going to add in the minimum down payment. So as we're going to learn about programs in just a bit, the minimum down payment for a conventional loan is 3%. We're going to assume property taxes of $5,000 a year. Different locations will have varying tax rates. Usually as a baseline for lending, we use anywhere between 1.15 to 1.25% for our property taxes. We're going to assume homeowners insurance of $1,000 a year, maintenance of $1,500 a year. So, let's think about it. When we own a home, I can't contact my landlord to come fix my hot water heater. So I'm going to have to pay that expense. So we want to budget that. If we're looking to purchase an older home, then we're going to have a larger, probably a maintenance budget that we want to set aside for ourselves. And then for loan information, we're going to add in a 30-year fixed mortgage, interest rate of 6.25%. That's about the average interest rate. I know that's quite higher than maybe what you've seen over the last couple of years. And we're going to explain what that means to you in just a bit. Origination charges, those are going to be what you have for closing costs as part of your lending. By the way, for those of you that are joining us and are Sac State alumni, you also have a discount that's available to you for closing costs. So normally in financing, we have a $910 processing fee. But as part of the alumni, we get a chance to reduce that processing fee to only $160. So a great added benefit for you as part of the Sac State team. And then other settlement charges will be closing costs that are included as part of your origination charges. But now these other settlement charges could be like third-party fees. Usually with purchasing a home, closing costs are going to be anywhere between 2 to 3% of your purchase price. Okay, so we had a question that came in. I'll just answer this really quick. The question is around property taxes, and the question is, the property taxes included in the mortgage, and where does that property tax go? So if you put less than 10% down, or you're using a first-time homebuyer program, it is a requirement that you include your insurance, so homeowners insurance and property taxes into your mortgage payment. So that is part of the setup for your mortgage financing. So in this scenario, we would have to have property taxes and insurance included into our escrow impound account. Property taxes are paid twice a year. So they're typically due in November, and they're also due in March. that money goes to the property tax assessor's office. So if you're going to, or tax collector's office. So if you're buying in Sacramento County, that would be the Sacramento County tax collector's office that receives those funds. Okay, and we can kind of expand on that a little bit more later on in the session. The other assumptions we want to make is appreciation rate. So we're going to put in 3% appreciation rate for our home over the course of 7 years. Now, for some of our current homeowners or clients that we've helped out over the last several years, especially over the last 2 years, appreciation rates have been 10 to 15%, right? Now, we don't want to project that into ownership because we're starting to see softening in the market right now, which we're going to talk about in just a second. But let's put in 3% for now as a placeholder. We're going to expect to be in this house 7 years. The cost of selling the house, we're going to budget for 10%. Now, why that's important is because eventually when we sell a home, we have to pay commissions to realtors that represent a buyer, but also represent you as a seller, plus all our other miscellaneous costs. Now, as a buyer, for those of us that are going to go out into the market and look for a home, when you have a buyer that represents you, or sorry, buyer's agent that represents you as the buyer, those commissions are not paid for you they're paid for actually by the seller. But when we turn around and sell our house 7 years from now, we're going to have to expect to pay those same commissions. We have the tax and state and federal tax rate. We have our savings rate of 1%. So we're going to kind of blend that into our total calculation. So here's what the calculator tells us. So if we look at a total cost over 7 years, in rent, I'm going to pay just over $200,000 over 7 years. If I'm paying continued $2,250, increasing 3% every year, my total cost of a mortgage will be about $162,000 a year. The difference is that when I buy a house, I have my equity appreciation, my potential tax benefits. And when I look at the side-by-side payment comparison, the mortgage payment's a lot higher. So we're close to $3,700 a month versus our $2,250. But when I kind of go back to my earlier point of it's not really an apples to apples comparison, because as we all know, when we're paying that monthly rent payment, we're not necessarily paying, well, it's probably paying the landlord's current mortgage on the property. And so we're not getting the benefit of, a return on investment of our rental payment. Whereas as a home ownership, yes, we're going to have a higher payment, potentially the opportunity to, create equity in our home. And the savings over 7 years is just over $38,000 when we look at buying versus renting. Okay, now I would encourage all of you to maybe do your own calculation when you have some time. And like I said, we'll get that slideshow over to you tomorrow morning. Okay. All right, so let's go ahead and jump back into our slideshow, and we'll kind of continue on. Now, I want to spend some time looking at the home, kind of the home market here, especially in the Sacramento County area. This kind of represents the median sales price, and I want to kind of do a quick look back, especially over the last 2 years. And for those of us that do live here locally in Sacramento, obviously we've seen a crazy housing market really across the whole country. As part of the pandemic, limited inventory, changes in work environment, many more buyers now working from home, incredibly low interest rates during the pandemic, as low as 2.6%. That all kind of fueled our housing market and made it very difficult for first-time home buyers to enter the market. I mean, it really was. I mean, not only were our buyers that we were helping with different programs, they were competing against 30 to 40 different offers on one home, and made it quite difficult. And a lot of our first-time buyers decided to kind of stay on the sidelines because it was just too hyper-competitive. Well, if we kind of fast forward now to where we're at in this current market, you can see the kind of the downturn here in the housing market, with the median home price starting to slip below this $500,000 mark. And I think when we're looking at it, I kind of mentioned this in my classes a couple months ago, we were already starting to see some softening in the market, and the interest rate pressures that the market is seeing is leading to a lot of that slowdown. So we're not seeing as many move-up buyers into the market. We are certainly seeing first-time buyers, because those same buyers that were on the sidelines are now kind of re-entering the market, potentially re-entering at a different price point because now interest rates are up higher. But I do think this kind of correction we're seeing with interest rates is presenting an opportunity for first-time buyers if it does make sense for their monthly budget. Now, as we kind of look further out, this is kind of the unknown of where we're going to see prices go. I don't think we're going to see major, 20, 30% corrections, but we're certainly seeing some softening. For those of you that are currently on Zillow, maybe you're on Redfin and you're kind of scouting out areas of your neighborhood and what homes are selling for, I would imagine you're seeing a lot more homes with price cuts because a lot of sellers have gone out to the market with these, 4-month-old prices that were much more competitive. And now they're realizing that buyers aren't necessarily willing to purchase at those levels. And so those homes are now staying on the market 30 days, sometimes 45 days. And obviously that's changing the dynamics in the market. And so I think as we're kind of moving forward and we're going into the latter part of 2022, we're probably going to still see that softening in the market. And so, as I mentioned earlier, as first-time homebuyers, being prepared and really understanding what your options are, even though it might be a higher interest rate environment, it still presents an opportunity for you. I think as we're kind of looking at this market and what interest rates are doing to it, in fact, today was a big day as the Federal Reserve announced a 0.75% increase in the federal funds rate. And the federal funds rate going up by 0.75% was really expected by most on Wall Street. And really what that is doing is to try to control what's going on with inflation. So the cost of everything is much higher for all of us that are in our communities. And so the raising of the federal funds rate is to try to kind of tame some of that inflation. And we'll probably see 2 or 3 more iterations of rate increases over time. Now, the federal funds interest rate does not necessarily correlate directly to mortgage interest rates going up. It is going to mostly impact our lines of credit that we have, maybe a personal line of credit, some of our credit cards, auto financing. It does have kind of a side impact to what's going on in mortgage rates. So a lot of what we saw with interest rates last week were kind of the expected increase that we're going to see in the federal funds rate. So rates really kind of moved up in the mortgage world last week. But now with the announcement of the federal funds rate going up, we actually saw interest rates come down just slightly this afternoon. So it's going to remain to see kind of how interest rates go. But right now, the average interest rate is probably around the 6.25% range. Now let's take a look back here. And I know we got a question here that I'll answer in just a second, but let's look back over the last couple of years. In the pandemic, we saw obviously rates in the 2.625 level. We've seen rates, by the way, we're looking at the blue line here. We see rates kind of spiking up. As we move into 2022, we started seeing rates hit that 5% level, pushing to the mid fives, and then just last week we hit that 6% threshold. So we will see how kind of interest rates settle down a little bit. I think as we get into the first part of next year, hopefully rates will start to level out a little bit. And I think the biggest question mark is going to be how quickly we can get inflation under control. So as we look at the historical, though, where interest rates are at, we're certainly not at what we saw in the 90s with rates in the 8s. I don't think we're going to go anywhere close to that area, but I think we need to prepare ourselves for a higher rate environment for sure. Question was, can you explain what the federal funds rate? So the federal funds rate basically controls borrowing costs. So what the federal fund rate is lending at. And so obviously, if borrowing costs are higher, the stock market generally doesn't like that. So we want to see cheap borrowing costs. That'll create more money supply. And so when federal funds rate is increased, that puts pressure to try to control and push down costs. And so that's why we're seeing inflation really, a big concern right now. And I think the number, if I'm not mistaken, from today's call that Chairman Powell mentioned, I think the goal is to get to 2% inflation. And that's why, they're kind of using the lever of interest rate hikes. Okay, good question. All right, so that's kind of where we're at with interest rates. And, as we consult with clients in building home buying plans, in fact, we would encourage you to connect with us for one of those after tonight's class. We're going to talk a little bit about interest rates and how those can impact you. I think as we look forward to what this market looks like, the reality is, recession is a concern, I think, for the economy right now. If we do go into recession, we'll probably see lower interest rates, but we'll also probably see more people moving away from the stock market, investing more in real estate. So I think there is an opportunity for first-time homebuyers right now to really consider what home buying could be for them, even if we're at a higher interest rate level. There is options down the road for first-time buyers when you are or an owner, I guess, at that point, to be able to look at refinancing. And so as your home appreciates in value, many homeowners take advantage of refinancing. In fact, that's what a lot of homeowners did over the last 2 years, with the rates being in the 2 to 3% level. So all interest rates are not created equal. They are at varying scales based upon a few different characteristics: credit score, the type of loan program that you're selecting, how much you're going to finance, what your down payment is. And then there's a thing called points or buy down costs that you can utilize to basically bring down your interest rate. So let's say we know that average interest rates, let's say, are about 6.25%. If I wanted to increase the cost of my borrowing, so my closing costs, I could potentially pay points to bring down that interest rate. Now, let's say I paid 1% of my loan amount, and I was borrowing $400,000. 1% potentially could equal a 0.25% reduction in interest rate. So we would want to make sure the return on investment makes sense for us to do that, but that's a potential option of buying points to lower my interest rate. And the next thing is term. Terms typically are 30-year fixed mortgages, especially for first-time homebuyers, because that spreads out our payments over the longer period of time. But you can look at 20, 25-year, 15-year, even 10-year terms for your mortgage. Okay, so one of the things we talked about as a characteristic of interest rate is credit. And credit is really going to control our borrowing costs. And it's really our job as kind of a mortgage advisor for you to help kind of guide you through credit and give you an idea of where you're at from a credit perspective. Now, the great thing is most of our clients that connect with us for consultations already have an idea of where their credit's at. There's so many great monitoring tools out there, whether it's Credit Karma, the tools offered through the different agencies like TransUnion, Equifax, Experian. All of those things can guide you as a consumer, so you have a really good idea of where your credit's at and kind of what it's going to mean for you in terms of your borrowing costs. Now, there's 3 different models when it comes to for credit scores. There's a credit card model, which is what many of you guys are utilizing to manage your personal credit score, but there's also an auto finance model and a mortgage model. So depending on what you're going to be financing or applying for, that's the model that, of course, would be used. Okay, so a question came in about FICO, and the question is, how accurate is FICO in terms of credit reporting? So FICO is the score that we're going to use on the finance side as well. There's a variety of different FICO scores based upon that model I just shared with you. The risk assessment within FICO for credit cards is going to look a little bit different than say a mortgage score FICO. And so many of our clients that come to us for consultations may have, let's say, a 760 credit score on credit card, but maybe it's 740 on mortgage. And it's just because there's a different kind of weighting for the score calculation. And that's kind of a good segue into this next part of the slide, which shows you kind of the weighting of score calculation. So 15% of this is going to be how long I've had credit. 20% is going to be the new credit that I'm trying to access. And more so, that's going to be new accounts established or new hard inquiries that I'm doing. So, we want to try to lessen the amount of inquiries that we have out there. Now, when we start our process, we start with a soft inquiry, which doesn't impact your score. But when you do hard inquiries, if you do many inquiries across different industries, so a credit card score, maybe a personal loan inquiry, mortgage inquiry, those all are going to create impacts to your credit score and potentially could decrease your credit score. Now, for both mortgage and auto, if you apply for credit within 30-day window of time, it's the equivalent of 1 credit inquiry hit to your score. So the next component is how much I owe, also known as credit utilization. That's going to be 30% of the weighting. And that's simply looking at your revolving accounts. So my credit cards, my personal lines of credit. So if I have $10,000 in credit limits and my balances are $5,000, that means I'm at 50% utilization. Our goal should always be to try to be below 10% utilization. And if we're running a little bit higher on our credit balances, let's say we're at 80, maybe 85% credit utilization, we really want to try to get that as low as maybe below at least 50% utilization. The next piece of the weighting for score calculation is, of course, payment history. That's the biggest weighting. That's just looking at how I paid my bills. If I've ever had past challenges like late payments, usually my late payments are going to be based upon 30, 60, and 90-day lates. So obviously, the higher the number of days of delinquency, the more impact it is to your credit score. Let me give you a quick tip on how I would recommend managing utilization on your credit. And so when each of us look at our credit card statements, there's going to be a billing cycle date, but there's also a due date. And if you're in the habit of paying down or paying off your balances by your due date, that's fantastic. However, whatever your balance is at the end of your billing cycle date is what's going to post out to the credit bureaus. And so if you're like me and you're trying to really maximize your credit score, I would encourage you to try to pay off or pay down your credit cards by the end of the billing cycle date, because at the end of the billing cycle is when your credit card issuer, so Cap One, B of A, Wells Fargo, they're going to all report the data of whatever your balance is out to the credit bureaus at the end of that cycle date. So if you can try to get it before the end of the cycle date, then you're going to get potentially an improved credit score. Now, every product has a minimum credit score. So for FHA loans, it's usually a 580 credit score, conventional 620, VA is 620, and then we're going to talk about the CalHFA first-time buyer assistance, but that has a minimum credit score of 640. Okay. One quick note on account closures. So it's important, as you're maybe you're in the habit, maybe not, of balance transferring and maybe closing out another credit card because you don't want to have access to another credit card. Just be mindful that closing out a line of credit basically pulls away all the history from that particular account. So especially if I've had more mature accounts that I've had, 10 plus years, and if I close out one of those credit cards, then I lose the length of credit as part of the credit models. So, you just want to be careful when you're doing balance transfers that you don't negatively impact your score by closing out a line of credit. Now, for financing, as I mentioned, we look at through all three agencies, so TransUnion, Equifax, and Experian. When we look at evaluating options, we take the middle score of those three credit agencies. So, for example, if I'm at 720, then 700 on my middle score, and 680 is my lowest score. So 700 is going to be the score that we use for qualifying purposes. Now, if my spouse is at 780, 760, and 740, their middle score is 760. But in lending, we always take the lowest middle score between the two borrowers. So we would still use my 700 credit score for qualifying. Okay. I'm going to take a quick pause there. Is there any questions I can help answer on credit? Because I think I threw a lot at you. I want to make sure that we got everything that we needed. We're going to talk a little bit more about some other credit items, but I want to kind of just give a quick chance for any questions that the audience has. Okay. Oh, let me just, okay, so I'll answer this question really quick. So question is, does co-signing not lower the interest rate? So if you're co-signing for a mortgage, we're still going to go off the lowest credit score between both borrowers. So whether you're a co-signer or a co-borrower, it still goes off the lowest credit score of all borrowers. Okay, good question. So really what a co-signer does, in fact, I was having a conversation with a client on this today. A co-signer is going to add, more compensating factors from an income perspective, maybe an assets perspective, that's going to make the financing stronger for maybe the borrower and the co-borrower. Here's a matrix just to show you how long negative items will stay on your credit. So those hard inquiries that we talked about earlier, they'll be on there for 2 years. You really want to limit hard inquiries in the last 6 months is what would be my recommendation. Late payments, those are going to be on there for 7 years, but really the items for late payments in the last 2 years are going to be the most impactful for you. Okay, let me tackle a few questions and then we'll move on from credit. Okay. So question is, does closing a secured credit card impact my score like a regular credit card? That's a good question. My guess is it's going to be the same if you close out a secured card versus a regular credit card, because at the end of the day with the secured card, you're basically buying a line of credit. So if I did a $200 secured credit card, I'm paying $200 for a credit limit. So whether you close that out or on that type of card or a regular card, I don't think there would be any difference. Okay, the other question is, if you have high credit utilization, is it better to transfer balances out or take out a personal loan? Great question. We see some clients doing that. I think it really depends, because I think at the end of the day, if you take out a personal loans can negatively impact your score as a negative trade line, because personal loans just have a negative impact to the score, especially recent personal loans. If you do a balance transfer, it's still going to look at the aggregate of your utilization. I think if you can still keep that utilization below 50%, a balance transfer is probably be the better path to go down. Ideally, obviously, paying down the debt would be the preferred option. Okay. And then I think I'll answer this last question, which is how does a loan from Upstart affect your credit? So that's kind of still in the same space of personal loans. So those are going to be like your SoFis, your lending clubs, your Upstarts. They're great. They're accessible. They're easy. They generally have high payments. So you want to be careful because those can bring down your credit score, especially in the most 6 to probably 12 months since you've taken on those new debts. Okay, I want to talk about student loans now, so we can make sure we discuss this. So student loans, and I know there's a lot of talk about student loans, especially because there's forgiveness going on based upon your certain economic situation. But at the end of the day, until those balances get reduced, as lenders, we still have to count whatever it is you have in balances towards your qualifying. Now, there's a couple different looks that we put to student loans in the calculation. If you're applying for an FHA loan, we'll usually use 0.5% of the balance for the minimum payment calculation. If it's a conventional loan, we use 1% of the balance for the payment calculation. Now, hopefully you're an income-based repayment amount because that'll give you the lowest available payment for qualifying. And because many of our clients still are in forbearance right now because of the CARES Act and the freeze on student loans, even with that, though, we still have to count that minimum income-based repayment amount or the 0.5 or 1% for qualifying. And that also holds true if you're maybe back in school and you're on deferment, maybe you're going to grad school, we still have to count a minimum payment against you for qualifying. Okay, so once those loans that are being forgiven, so the $10,000 or the $20,000 in balances, once that actually reduces down your balance, then we would have a different calculation for the student loans. Okay, so that's a little bit about student loans. Now I want to kind of shift gears and talk about loan programs, because these are really important to learn as you're moving forward. And certainly during a consultation, when we meet with you one-on-one, whether over video, over phone, we'll help design this for you. But I want you to kind of understand some of the characteristics of loans, because I think we hear a lot out there or we see a lot in our searches, but really understanding where these products can benefit us, I think is super important. So primarily for first-time buyers, we're going to be looking at conventional or FHA loans, but there's other products available too as well. VA loans for our veterans that have served, USDA loans, those are going to be for more of our outlying areas, some of our foothills going up north. Some of those areas are going to qualify under USDA, which is a 0% down option, but it also has income components based upon where you're looking to purchase. And then jumbo loans are going to be for our clients that are trying to purchase beyond the conforming limit, which actually just went up to $715,000. So if you're financing more than $715,000, there would be the jumbo loan. And usually that requires 10 to 15% down payment. Now with conventional and FHA loans, much lesser down payment. A conventional loan is also like the Fannie Mae and Freddie Mac loans that many of you have probably seen in your searches. Minimum down payment of 3% for first-time buyers. If you're a second-time buyer and you've owned in the last 3 years, then it's a minimum down payment of 5%. FHA loans, it's always a standard 3.5% down payment. Both loans will go up to $715,000. Okay, so that's the new conforming limit for 2023. We've brought it out a little early in preparation for the new year. But so that's what's active right now. For those of us that are going to utilize the Cal HFA assistance program, which we're going to talk about in just a bit, that is still at the lower conforming limits, which is at 698 here locally in the Sacramento County area. The limits do vary by where you're going to purchase in the country. Of course, if we get into the Bay Area markets, Southern California markets, those limits can change a bit. Now, when we purchase a home and we put less than 20% down, there's a thing called private mortgage insurance. And private mortgage insurance is going to take different kind of shapes and kind of in structure based upon the product that we're going to use. With a conventional loan, when we put less than 20% down, like I said, we have the mortgage insurance, but it's going to be tiered based upon a few factors: what our credit score is, what our down payment is, how much we finance. And there's different payment options for mortgage insurance. There's monthly mortgage insurance. There's what we call split mortgage insurance, where you can take part of it monthly, you can pay part of it upfront. There's also single premium, allows you to buy out the mortgage insurance, but it increases the cash out of pocket. And then there's lender paid mortgage insurance, which isn't the most popular because it basically takes maybe a 6.25% rate and then puts it up even higher to buy out the mortgage insurance. So our goal is to get the highest credit score, put the most amount of money down, and hopefully finance the least amount, because that'll help lessen the cost of mortgage insurance. Usually when you have at least 2 years in your home and 20 to 22% equity, you can apply to have your mortgage insurance completely canceled. So many of our clients that we've helped over the years that have had this great appreciation, were able to cancel their mortgage insurance and not have to go through the cost and the experience of refinancing their home. So a great opportunity. And that's going to be a big deal, especially for clients that bought their homes over the last 2 years, because once they get that appreciation, they can hopefully cancel that mortgage insurance. Now, with a conventional loan, let me just show you what that calculation looks like for PMI. So let's say I bought a $450,000 house and I had a 740 credit score. The minimum down payment is going to be 3%. Now, the monthly MI is going to be about $183 a month. Okay. So now if I had a 720 score or maybe a 700 credit score, that MI would start to go up higher. Maybe that's $250 a month. So I would say, a lot of our clients that we work with, when they come to us and we do the calculations, they're like, oh, I didn't realize the PMI was that, that low, because a lot of the calculations on your Zillow or your Redfins are going to be a little bit higher because they're not like calibrated based upon those criteria that we talked about. Okay, so I answer a few questions here that just came in. Then we're going to talk a little about FHA to keep us on track here. And one question was, is a chattel loan similar to a conventional loan? The only difference that you don't own the land. A chattel loan is going to be kind of like a, I think it's going to be more of a subordinate loan that's going to be in second position. A conventional loan is going to have standard conventional guidelines like Fannie Mae and Freddie Mac guidelines. And we can get you, and we'll send a follow-up on, chattel kind of like characteristics. We can send along to you as a follow-up today's session. And then, okay, then the question was, what would be an area considered for USDA? So, probably Placerville, for example, would be an example. A lot of your foothill areas, Cool, Pioneer, some of those areas. Going up north, gosh, when you get past Woodland, some of the smaller communities out there, Williams, for example. All right, and then I'm gonna, and then just last question I'm gonna actually table to the end. Maybe you can save that one for me, Ken. We'll so we can stay on topic, but and we'll talk about that during our wrap up. So, all right, good stuff. All right, let's talk about FHA mortgage insurance. A variety of different payment options that, there's not the same payment options, I should say, with FHA loans for your mortgage insurance, because mortgage insurance on FHA loans is a standard 0.85% of your loan amount. And not only is there monthly MI on FHA loans, but there's upfront mortgage insurance, which is 1.75% of your loan amount. And with FHA loans, you can only cancel by refinancing out of an FHA mortgage. So it's a lot different than conventional loans. You don't have the tiered system based upon credit score and down payment. And then when we look at FHA mortgage insurance with the same $450 sales price, the monthly PMI is going to be about $324 a month. So close to, almost double what we're going to see with a conventional loan. Now, you may kind of step back and say, why would I ever consider FHA if I know conventional is just a lot cheaper option? Well, it just depends, because, the guidelines for FHA and conventional look a little bit different. FHA loans have a little bit more leniency when it comes to maybe past bankruptcies. So maybe I had a bankruptcy 2 years ago, FHA would be okay with that. But a conventional loan would want to see at least 4 years out of a bankruptcy. Or let's say I had a foreclosure and that foreclosure was 5 years ago. FHA, no problem, but conventional would want to see 7 years out of the foreclosure. So different kind of characteristics within the guidelines would, have us kind of maneuver to one or the other products. Now, as part of a consultation, we're going to design a home buying plan. We'll kind of figure out what's the best fit for us, or for our client, I should say. So when I say us, we're working together for you on your home ownership plan. So I think that's where we'll kind of design something that makes the most sense for you. Now, we're going to look at income now for qualifying on the mortgage, which is one of the final components before we get to assets for the down payment. And let's talk just really quickly about the documentation, and then I'll talk about some kind of misconceptions on income and employment. Usually with our W-2 wage earners, we're going to need the last 2 years of W-2s, 30 days of pay stubs to verify kind of the consistency of earnings, and then we're going to do a verification of employment. For self-employed individuals, a little bit different. We're going to need 2 years of tax returns. Usually the profit and loss statement and a balance sheet, it's a little more complex when it comes to self-employed individuals. So it really depends on your tax structure and what documents we're going to need. And then we're going to verify the business through like a business license or maybe even a CPA letter. So that's generally what we'll need. Now, a couple different scenarios that come up when it comes to employment and income, which is pretty important, especially coming out of the pandemic where we had, incredible unemployment rates. And we had, so many people displaced from their jobs, but many people re-entering the workforce, maybe they're changing fields or whatnot. And so when we look at that, if we have a client that has now regained employment and they're on a full-time schedule, we can utilize the full-time earnings, even though that maybe we're displaced from their job in 2020. So that's certainly allowed with underwriting guidelines. There is a rule that you need to have at least 2 years on the job and or education that's supporting your current line of work. So one of the examples I use, and this is great for some of our Sac State alums. So if we graduated just this last spring, for example, we finished up our undergrad in accounting, and then I went and got a great job over the summer, and now I'm working, but I've only been in the workforce for, let's say, 6 months, but I had my undergrad for 4 years. We can still use the education and the employment to meet that 2-year requirement, okay? If we're transitioning jobs, let's say I'm working for, a private company, and then I got a job on with the state. I can use my new earnings with the state as long as I can verify that it's full-time employment. Now, if I have dual employment, so let's say I'm in the healthcare field and I work for 2 different clinics and I can show that I've worked for both for 2 years, then we can use both sources of income. But if we've only been there maybe part-time and it's 6 months at one and 1 year at the other, then unfortunately we couldn't use those sources of income. You have to be able to show consistency of 2 years. Okay. I'll let you take that question. Okay, perfect. Okay, let's talk about additional income. So if I have full-time employment, let's say I have a 40-hour work week job, but then I also drive for Uber on the weekends, right? As long as I can show that I've been driving for Uber for 2 years, so 2 years of tax returns, and then plus I have my full-time job, then I can use both sources of income. Usually with your 1099 income, it's going to show up on a Schedule C form on your tax returns, and then we'll do an analysis to see what is eligible. Okay. Let's see what else, any other questions that come up as terms of income scenarios that, anything you can think of that we should,
No, I think we already talked about self-employed and things like that.
Okay. Okay. Perfect. Let me just check our question box. Okay. So question on, and this is kind of more on assets that we'll talk about in just a bit, but the question is, are bank statements required 3 months? Bank statements are required. That's going to be part of the assets that we're going to learn a little bit more in just a second. We usually ask for 2 months of asset statements. Okay, and then I'll answer one more question here on income. Not be able to qualify. So the question came is, does this mean if you haven't been at the same job for 2 years, you would not be able to qualify? So no. So you can be on the job for 6 months and you can still qualify. What we're asking for is a 2-year work and or education history. So, if you, like I said in my earlier example, if you transition to a job, let's see for the state, we can use that income right away because now we've verified that you're full-time with the state. A lot of our clients that are new to the work industry that maybe just have an offer letter but haven't started their job yet, we can still qualify them off of their offer letter. Okay. So a question came in, client's been or attendee's been on workman's comp for 2022 so far. How would that affect me if I wanted to purchase in 2023? So the workman's comp is going to be temporary income. Once you've solidified full-time income, then we can use that full-time income right away. We will have to verify 2 years history of, previous employment or education, but as long as you're able to show your new employment, then that could be used right away. Okay, so let's stick with income for just a bit because I want to talk about now income and let's compare that versus our obligations. And for lenders, we do a calculation called debt to income ratio. What it does, it takes your gross monthly income versus your expenses. And we want to make sure that we're creating an affordable situation for you with home buying. Usually we don't want your monthly obligations to be more than 43 to 45% of that pre-tax income. Now that's not always a great measurement because when it comes to affordability, that's going to be the one-on-one conversation we have together to really understand, what's it going to look like when we pay that $3,000 mortgage payment? Are we still going to be able to go to Starbucks because we like to go every week? Or, how are we going to do with our daycare expense? Or can we still do our entertainment night? And I think that's where we got to have that conversation around budget, because the debt to income ratio is measuring gross monthly income, not necessarily net income. So I think there's a big kind of disconnect there. Nonetheless, in financing, we have to kind of look at that debt to income ratio, which takes into consideration the mortgage, the principal, the interest, the property taxes, the mortgage insurance, the homeowner's insurance. If I'm going to buy, let's say a condo, I'm going to have an HOA expense. Not all of our clients love those, but you are going to have that if you buy a condo or a townhouse. And then I have to look at my other debts. So if my mortgage payment with my HOA is $2,500 and then I have $500 in other debts, that means I have total obligations of $3,000. And if I divide that by 8,500, in this scenario, the client's debt to income ratio is 35.2. Most of our clients feel pretty comfortable around 33 to 36% debt to income ratio. I think it's probably no surprise that we're seeing a lot higher debt to income ratios in this inflationary environment because it's just more expensive to live right now. So we're kind of seeing that, but ideally, probably the debt to income ratio that keeps most of our first-time buyers pretty comfortable with their payment is around 33 to 36%. But again, this is going to be a conversation we have one-on-one to understand what the best home buying plan looks like for you. Now, the question came up around bank statements. So this slide is going to answer that question for our attendee. We are going to ask for the last 2 months of bank statements when it comes to verifying assets. If there's any cash deposits, those can't be used. Unfortunately, everything in financing has to be paper trailed. So if I'm getting my refund in February for my taxes, right? So that's going to be paper trailed because I'll see the deposit from the U.S. Treasury. That's totally fine. But let's say my uncle gave me $5,000 in cash. In that scenario, that couldn't be used. Now, your uncle can gift you funds for your home purchase, which is completely allowed, but it can't be through cash. It has to go through a financial institution, like transferring from B of A to Golden One. That's completely allowed. 401ks, 403bs, even IRAs can potentially be used for home buying. You just want to double check with IRAs because you don't want to create a tax liability for yourself. Usually with 401ks and 403bs, you're borrowing or taking a loan out against those financial instruments. Obviously, we're in a down market when it comes to the stock market. So those balances aren't as high as they once were. So you want to be careful that that's kind of the right financial move for you. Really encourage you to talk to your financial advisors or maybe even your tax advisors when it comes to utilizing those assets. Gift funds is the last thing we want to kind of spend some time talking about. That's where we have a family member that's going to help us with our home purchase. Those funds do not need to be seasoned, which means a seasoning requirement is usually 60 days of assets. But if a family member is gifting you funds, that can be done right away. That can be transferred to you to your bank account. It just needs to be documented for qualifying purposes. Okay. Any questions about assets before we move into our first-time buyer segment or the assistance programs? Okay, I'll go back if we do have some questions on assets. When we work with first-time home buyers, there's probably I would say probably two things that maybe get in the way of home ownership. Could be credit, because maybe we've had some past challenges or maybe we're a little overextended. But more often than not, it's especially for our first-time buyers, it's just not having enough resources to afford my down payment or my closing costs. And so we've partnered with Cal Hfa. Our team has been with Cal Hfa for the last several years, and we're proud to be the leading provider of the Cal Hfa assistance product across California. So we help everybody from Eureka all the way down to San Diego with these programs. And it's designed to help low to moderate income families achieve home ownership. Especially now, it's been super popular, and there's a variety of different kind of product paths we can go down with the program. And so I want to kind of spend some time sharing some of these tools and resources for you. Many of you might even heard about some of these. One of them is the Equity Builder that's got a lot of notoriety in the last probably 4 to 5 months. And the Equity Builder provides up to 10% of your sales price in assistance. And it's basically a grant or a forgivable loan after 5 years. It's designed to help low-income families. So if you're in the Sacramento area, it has a maximum income of about $81,000. For those of you that are joining us from the Bay Area, there's higher income limits based upon the county you're going to buy in, but it's just a great product. And we've got a chance to help several clients with this program. The next program is designed for more moderate incomes, and that's called the My Home Assistance Program. For a conventional loan, allows you to get up to 3% of your purchase price in assistance. For an FHA loan, it's 3.5% assistance, but it's a low interest loan. It's at 1% interest, and it just needs to be paid back when you either sell the home or if you refinance in the future. Now, it has much higher income limits than the low income housing product. In fact, in the Sacramento area, you can make up to $180,000 to be eligible on the moderate income product. Now, a program I'm just going to give you guys a little bit of a glimpse into. You may have seen some talk about this online, but it's still kind of under construction right now. And I've had the pleasure to be able to sit on calls with Cal Hfa kind of going through this program. And it's called the California Dream for All product. We're probably about 3 to 6 months away from the launch of this program, the last I checked. But what's really cool about this program, it provides up to 20% in assistance. It's either going to be a low interest or a no interest loan that's not paid back, similar to the My Home product, until you sell the home or if you refinance in the future. Again, it's 20% in assistance, but it's more designed for our moderate income families that maybe can't qualify in that equity builder product. And think about it, when you put 20% down, then you have no mortgage insurance. So it creates more affordable payments for our families. But it does have another component that's still being ironed out right now, which is an equity share agreement, which you could potentially, that you would have to pay back 20% of the accrued equity in the home from purchase. And so those are things that are being kind of ironed out. And I can't really go into much detail at this point. I know there's some talk about it online, and it's something that's being kind of worked through as we speak, but it's a great opportunity. And I think it's something I would encourage you to stay tuned for. I would really encourage you to follow some of our social channels, like on Instagram, and we're going to be sharing this with our client database as we get more information on the release date, but could be a fantastic opportunity. So that's the California Dream for All program. I want to spend some time talking more about the products that are active right now. So the Equity Builder program, as I mentioned earlier, these are the income limits by some of our neighboring counties. So in Sacramento County, it's $81,920. And then on the other side of the slide is our moderate income limits. Okay, so Sacramento, and actually I forgot, Sacramento just went up to 202 because every June the new limits are posted. And so it was 180, now we're at 202. Okay. Just to kind of reiterate, so a question came in, for these loans that you have to repay after selling the house, are these paid back in monthly payments or one big payment? So on the assistance programs, if it's a repayment, it's paid back when you sell the home or if you refinance. It is paid in one lump sum. So if you refinance, it generally will absorbed into your new first mortgage of your refinance. And of course, if you sell the home, then it will be deducted from your sales proceeds. Okay, so the Forgivable Equity Program, I've already talked a little bit about it. Here's a little bit of a snapshot of what it looks like. It's up to 10% of your sales price or appraised value, whichever is less. As long as you stay in the property for 5 years, it's completely forgiven and it is interest-free. Now, it has a maximum down payment of 20% from the borrower, 10% from the program, so a total of 30%. So you're capped at that, because we really want to make sure that those that are taking advantage of the program are those that are truly in need. Okay, so let me just show you just a quick example of what the Equity Builder program would look like, and we're going to use a $450,000 sales price. And just for time purposes, I'm going to kind of walk through this relatively quick. So if we assume a 3% down payment, estimated closing cost of 2 to 3%, usually you're going to need about $22,000 to $27,000 total out of pocket to purchase at $450,000. Now, if I was eligible for the Equity Builder program, now what I have a couple different options, but we're going to show you a scenario that I think could make sense, which is, I could put 7% down. So I would take 10% of my, or take the 10% of Equity Builder I'm getting, 7% used for my down payment, the other 3% towards my closing costs. And now I have up to $45,000 in assistance. I could use a scenario like that to basically cover my entire down payment and also cover my closing costs, so I have a minimum amount out of pocket. You have a variety of different kind of scenarios we could run with that, which some of our clients will take the 10% assistance and use it all to put down towards their down payment, and then they would just put the closing costs out of pocket. So that's an option too. It'll be important for us to kind of design those options when we go through like a consultation with you. Now, for the moderate income program, there's the My Home Assistance, and then the ZIP Assistance program is still active right now, not as attractive right now, just given the interest rate environment. But the My Home Assistance provides up to 3% of the purchase price in assistance, or 3.5%. So that's that low interest loan that we talked a little bit about earlier. And then kind of here's an example of what that assistance would look like through My Home. Okay, so I'll kind of just take that same $450 purchase price, the My Home Assistance of $13,500. If you wanted to add zip assistance, now we have eligible $23,000 to $28,000 in assistance. More than likely, what we would see in a scenario like this, we would take the $13,500 My Home Assistance to help offset your minimum down payment. And then, like I said, you would have the closing costs out of pocket. Okay. All right. So, and again, you're going to be getting this material as a follow-up to today's session. Here's all the eligibility requirements for Cal HFA. So I'll kind of keep moving through the rest of tonight's content so we can kind of stay on track with our time frame here. But at the end of the day, this is going to be designed for a first-time buyer program. So, and a first-time buyer is someone that hasn't owned in the last 3 years. So you could potentially have owned, 5 years ago and sold your house 5 years ago, and you now in 2022 you would still be a first-time buyer. Okay, so hopefully you felt that assistance program was helpful for you. Again, that's been such a great resource for hundreds of first-time buyers here in the Sacramento area as well as across the state. Love to be able to share that information with you. Next thing we want to talk about is the 6 steps of home buying. So this is our 6-step process. And step 1 is going to be our pre-approval. That's when we get a chance to pre-approve you for your home purchase. That is the output of a consultation with us. And the pre-approval is a certificate that allows you to be able to present an offer to a seller and show them that you're qualified for your financing. Usually the pre-approval is good for 60 days, but it can be easily recertified at any time. That'll be something that can also be adjusted to based upon, what offer you're going to make to a seller. Okay, so that's step 1. Step 2 is going to be house hunting. That's where you get a chance to go look at various homes. Usually it's going to start with an online search. And then once you've found a few homes that fit the criteria, location, size, all the specs that you're looking for in a home, then you can make an offer on that home or go out and look at that home and then make an offer. Usually a realtor will help you with that offer. We really encourage you working with realtors. As I mentioned earlier today, realtors are paid for by the seller. So I really encourage you to take advantage of that resources. I think it's a great opportunity for you. So that's step 2. Step 3 is going to be when we've submitted an offer and now a seller has accepted our offer, we're going to enter escrow. So that means we have a ratified agreement with a seller. And at that point, a timeline starts. And it's usually a 30-day timeline from acceptance of offer to all the way down to step 6 when we get the keys to our house. Now, once that happens, we're going to be connecting with you to now set up your follow-up consultation. And that follow-up consultation is going to give us the opportunity to go through all your closing costs, your interest rate, your payment breakdown. Make sure you have a great understanding of all your financing and how everything is built. If you have an assistance program, we're also going to review that as well. So we'll spend about 30 to 45 minutes in a follow-up consultation. Within 2 to 3 days, you'll be required to make what we call an earnest money deposit for your home purchase. Usually that deposit is going to be 1 to 2% of your purchase price. Now, that money is held in what we call escrow, and it's protected there because you as a buyer have the right to do your due diligence on the property. And that's called a contingency. And the contingency is usually within the first 14 to 17 days of your contract. So within your contingency, you're going to get your house appraised, which us as a lender will order the appraisal for you. Your realtor will help you with ordering inspections on your house. And then as the lender, we'll get your loan approved. And it's really important for us to make sure that we're getting all the activities completed within that contingency period, because we want to give you as the buyer all the information you need to make a great informed decision. Because once you've lifted your contingency and signed off on those items, then you're basically all in on the transaction. So if you decided to cancel a couple days later after canceling or signing off on your contingencies, then you could risk losing your deposit. So we want to make sure that we have a sound investment. We've done our due diligence before we go ahead and clear that contingency. Step 4 is going to be processing and underwriting. That's where we get a chance to do all the administrative tasks of the loan. We're going to verify your employment, verify the assets you're using for the home purchase. Prior to that point, your interest rate is going to be locked in. By the way, as a side note, especially for first-time buyer programs, we can't register or lock in your interest rate with the state until you actually have an accepted offer with the seller. Step 5 is going to be loan approval. So we've issued a loan approval. And there'll be some conditions that our team would work on with you, because that's just how underwriting works. There'll be conditions after they've reviewed your application. It also brings us to the end of that contingency period that we talked about. And at that point, we're going to issue to you your final closing disclosure. And that gives you a 3-day cooling off period before you move to the very final stage. And that's called closing your loan. That's step 6. Everything up to that point can all be done via electronic signature, but at step 6, you're going to be signing final loan documents with what we call a public notary. That takes about an hour or so to complete that task. Once you've done that signing, you'll be required to wire in any of the funds that are still owed for your transaction. And then us as lenders complete one more final audit. We just want to make sure all the signatures are right where they're supposed to be, make sure all the financing is designed properly. And then we'll wire in the funds for your first mortgage as well as your assistance if you're electing that program. The escrow company, whose role is to kind of control some of the funds that are coming in the transaction, will make sure all the money is balanced. The seller's receiving what they're supposed to receive. You've contributed what you're supposed to as a buyer. And after that's been balanced, then documents get recorded with the county recorder's office. They record usually a grant deed, and that transfers ownership to you. And they also record a deed of trust, and that's your agreement to repay the loan. And once that's all completed, then you become the official owner of the home. You get a chance to high five, your friends, family. You get a chance to celebrate because it's a big accomplishment. You've probably made one of the biggest financial purchases that you've had in your financial lives, right? So, and we want to celebrate right along with you. So we try to make a very connected process for you. Our team is always available to answer questions via text, instant message, phone calls, emails. We try to make ourselves as accessible as possible because we understand it's going to be a journey that's going to be one of anxiety and, just a little bit of stress. So we want to try to kind of guide you through that process. Quick side note in that process, if you're electing a first-time homebuyer program, there is homebuyer education required. We can get you the link to that. That's not required to be worked on at least until you have an accepted offer with the seller. Okay, so you heard me mention a little bit about consultations throughout tonight's session, and that's kind of the first step on that path towards homeownership. That's where we get a chance to connect with you for a one-on-one. Starts with the online application. We do a soft credit score pull for you. You'll upload some documents, and then we would meet to discuss your application, design a home buying plan for you. That session's about 20 to 30 minutes. It's a free service we provide. It's not something where you're committed to lending or going out and finding a house right now. We just want you to be able to have all the right tools and resources to make a great financial decision. Now, after tonight's class, if you have some questions and you just want to maybe connect with us for a one-on-one, myself or Ken, we'd love to be able to meet with you for an intro call. That's just to kind of maybe do some follow-up on some of the questions you had from tonight's session. Here's the framework of the consultation. So we're going to do that budget analysis. We're going to talk about where we want to buy, how much we have set aside for our savings, what's the right budget that we feel like we can get to that's not going to put a stress on our finances. I'll walk you through the home buying process, and hopefully we'll get to a place where we can issue a pre-approval for you and start that journey of home ownership and get on the road to step 2. Here's a great tool we have called a mobile app, and you can start the application process right from mobile. You can follow the progress of your app throughout that 6 steps of home buying. You can upload documents. And what we find a lot of clients doing, especially over the weekend, is usually utilizing the calculator function to figure out different payments for homes that they're searching for throughout the weekend or even during the week. We're really proud of all of our community partnerships. I mean, it's an absolute joy to be able to provide education to our communities and homeownership. We are, I would say, the leader in homebuyer education. We've been doing this for the last several years. We want to really invest in our communities and really help people. And we're affiliated with all these different universities that you see here on the screen. And we're obviously most proud about our new partnership with Sac State. And because of that partnership, you do get the discount of $750 and access to all the things that we do to help our communities in home ownership. So I'd love for you to take advantage of that at some point. We have other classes that are coming down the pipe as well. So we're doing it for different markets that we service. So if you have friends or family or maybe some coworkers that you think might enjoy some of this content, please feel free to have them check out mortgageeducate.com and they can sign up for one of these free classes. And this is all my contact information. So if you have some follow-up questions after tonight, feel free to message me. Whatever the question might be, email us. That's totally fine. Really encourage you to follow us on our social channels, especially with some of the great information that's now coming out for the different iterations of first-time buyer programs, including the California Dream for All product. And we're really proud of our testimonials of clients. So really check us out on some of our reviews. I think that's really cool what some of our clients are saying about us. So I know we're a little bit over our time schedule. I was trying to squeeze in a lot because I wanted to hit my commitment of 7 o'clock, but we're going to hang out and answer some questions now. I'm going to start with our first question, and then we can kind of knock out as many as we can. And please, we'll hang out here until the last question's answered. So let me just kind of read this first question. Okay, so question came in about, with us helping out, clients in home ownership, how much are our services? So there is no cost to do a consultation, and there's no cost for your pre-approval or anything like that. Closing costs are gathered from a lender once you close escrow on your home. So once you reach step 6 in the process. So there is closing costs that are part of the origination charges, which I think we kind of talked a little bit about. So that's part of what lenders charge in financing. But for all the upfront work that we do, there's no charge for that. I think I have a question earlier that I missed.
It was rent to own.
Oh, rent to, okay, gotcha. I think there's quite a few of us still online, so feel free to go ahead and send us a chat or Q&A with any questions, and I'll answer those on air. Okay, so a question came in, would FHA be the best option if you're 2 years old on a Chapter 7 bankruptcy? So potentially, yeah, because on FHA, they only require 2 years out based upon the discharge of the bankruptcy. So that might be a program that we would consider. Yeah. You're welcome. Thanks for joining tonight. I have to say, for our first Sac State alumni workshop, this has been awesome. You guys have been great. I love all the questions. All the participation's been wonderful. We're really excited to be able to bring this content to you. By the way, we are going to have another Sac State workshop, hopefully by the end of this year. Generally, we'll do for each of our partnerships, we'll do a quarterly workshop. And hopefully we're going to be doing some hybrid in person. I know we're probably not there yet, but we'll still be doing Zoom classes. But, we're excited to be able to bring all this content to our Sac State team for sure. Okay, got a couple more questions coming in. So question is, the question is, will we be doing one for UC Davis? So we do one for the Davis market. I don't know if we can say that on a Sac State call, but yeah, we do one for the Davis market. We did have one with UC Davis that we did a few years back, but anybody's allowed to or welcome to attend any of these classes for sure. So, how fast can I get a pre-approval is my next question. So usually pre-approvals can be done as quick as 24 hours. So the biggest thing is just starting that application, getting your items uploaded, and then scheduling a consultation with us. We can help prioritize pre-approvals. We have some clients that, have already found a house that they want to make an offer on. But we have some clients are looking to buy next year. So we can help prioritize based upon, the need to get the information you want to see as quick as possible. Okay. Any other questions out there? Oh. So let's kind of answer a couple more. If we do not have a lot of savings right now, should we consider waiting to start the consultation process? That's a great question. My recommendation is to start the consultation process whenever you want to learn more information and build a plan. I think a great plan starts with kind of really understanding what it looks like, right? And setting some goals and whatnot. So, I talk to clients that have $200 in their bank account or $200,000 in their bank account. I think really just understanding what your goals are, because maybe you're not ready to buy until next year, and that's a conversation we can certainly have. But I think it's really important to know what the goal looks like, and then you can kind of work to meet that goal. As you've learned, there's some great assistance programs out there. There's going to require some minimal amount of money out of pocket, but homeownership is so much closer than a lot of us think. I think a lot of people believe that, and probably the biggest misconception is that I need 20% to purchase a home, and it's not necessarily the case. So, but yeah, I'd encourage you to connect with us whenever you feel like you want to get more information. So, here's a question came in. Is there truly ever a good time to buy, do the market? I've talked to a lot of people that regret not jumping in just because they're afraid of the big purchase. I think that's the big question, right? I mean, is it time to get in the market? Is it not the right time? Whether it's interest rates, whether it's homes that are declining, homes appreciating, we just don't know. I think like everything, housing market cycle, interest rate cycle, I probably get that question once a day. And I think ultimately it's just really important to really understand where your finances are at, what's most important to you and what some of those goals look like for you. Because I think if you're trying to buy something to create sustainable and affordable home ownership, then I think it's great to look now. If you're trying to purchase to make quick money, that's probably not, the best approach. So I think everybody's situation is a little bit different. And I think that's where we can kind of build a plan, and whether it's buying now or buying next year or 2 years from now, at least you kind of know, like I said, what the goal looks like. Next question is, can you define the My Home versus the Dream Loan again? So the My Home and the California Dream for All are going to be both designed for moderate income households. So up to that $200,000 number for Sacramento. My Home is 3% of your purchase price. The California Dream for All, by the way, under construction is slated to be 20% of the sales price. So that's kind of the difference. Same type of, income limit, but different amount of assistance. And like I said, California Dream for All still under construction. Stay connected with us, because we're going to certainly broadcast information as we get it. You can go to our website too. I think we have it shows under construction on our site, but we'll be posting information as we get it. Follow us on our social channels, and certainly we'll be able to connect with you on email too with some of those updates. Okay. All right. Anything else? I know I'm over my time frame, so I want to respect your evening here. Okay. I think that, okay. I think that brings us to the end. Well, if you didn't get your question answered on air, please feel free to connect with me. It was a pleasure bringing to you all the information. I hope you really got a few things out of it that can help you on your journey towards home ownership. I appreciate you taking time out of your busy Wednesday night, and hopefully